Assalamu alaikum. This is the first lecture in the series of lecture for chapter number 10, mortgage-backed sector of the bond market. Starting from this chapter and for the next two chapters, we will be discussing mortgage-backed securities, asset-backed securities, and their valuation. So these three chapters are pretty important to understand the how to securitize different kind of loans, basically. So, what are the mortgage backed security sector? It's simply referred as the mortgage sector of the bond market and includes securities which are backed by pool of mortgage loans. This sector mainly backed by residential mortgage loans. We refer to this as residential mortgage-backed securities. And at the end of this chapter, we also discuss the commercial mortgage-backed securities. We will also discuss about the agency mortgage-backed securities and non-agency market-backed securities. So let's start talking about the residential mortgage loans first. Before talking about residential mortgage-backed securities, let's first talk about residential mortgage loans. Well, a mortgage loan is a loan, as we already know. It's a loan secured by a collateral of some specified real estate property, which obliges borrower to make predetermined series of payments. So it's against some specified real estate. The mortgage gives the lender right to foreclose on the loan if borrower defaults and seizes the property in order to ensure the debt is paid off. So it's basically right on that underlying asset that the lender can have the possession of that underlying asset and he can sell that asset. Okay. Conventional mortgages are based on loan based on the credit of conventional mortgage loan are based on the credit of borrower and on the collateral for the mortgage. So the whether lender is going to lend or not, it depends on two things. One, the credit of the borrower and the underlying collateral. Lender may also require some insurance to insure him against the default. A mortgage design is a specification of the interest rate. So now, what is a mortgage? How it works? It's a specification of interest rates, term of mortgage, and the manner in which borrower funds are repaid. So there are basically various different type of mortgages, starting from fixed rate, level payment, fully amortized mortgages, which these kind of mortgages pay fixed payment, and their mortgage rate is also fixed, and by the end of the life of the mortgage, all of the principal is also paid back. Then we have adjustable rate mortgages, in which mortgage rate is adjustable relevant to some benchmark. Then we have balloon mortgages, in which some balloon payment is also acceptable. Then we have growing equity mortgages. These kind of mortgages are basically in which the share of borrower increase periodically. Then we have reverse mortgages and tiered payment mortgages. We are not going to get into a lot of detail. Most of these mortgages are very similar to each other. We will just discuss in detail the first type and how this how the cash flow occurs on the first type, which is fixed rate level payment, fully amortized mortgage. Rest of the mortgages are just the some tweaking here and there in the fixed rate mortgages, and you can create an other type of mortgages. So let's focus on our main underlying mortgage, which is the fixed rate level payment fully amortized mortgage. So the mortgage rate is fixed for the life for these kind of mortgages. The dollar amount of each monthly payment is same for life of the mortgages. The payment does not change. So it's an annuity. When the last scheduled monthly payment is made, the remaining mortgage balance becomes zero, right? So these are the basic characteristics. Each monthly mortgage payment for this mortgage design is due on the first of each month and consists two things: interest of 1/12 of fixed annual interest rate times the amount outstanding mortgage balance at the beginning of the previous month, and a repayment of the portion of the outstanding mortgage balance. Let's illustrate this example with the help of a mortgage. So let's assume or consider a 30-year, 360-month, 100,000 mortgage with a mortgage rate of 8.125%. This is given in the book in Exhibit 1 of the Chapter 10. I have designed this Excel sheet for your convenience. Let me move this screen share to that Excel sheet, then we will discuss in detail. Okay, so here is the Excel sheet for the calculation of this mortgage loan. So remember, we have a mortgage loan for 100,000. Mortgage rate is 8.125. So this is basically 8.125. Why it shows like this? Okay. This is 8.125. Okay. So 8.125. Okay. So PMT will be okay. So terms of loan is 30 years, 360 months. We can calculate PMT from this. In calculation of PMT, I have used the annuity formula. So we have to divide the present value with this annuity factor. And this annuity factor is same 1 minus 1 plus I, because it's monthly, I divided by 12 power minus number of months divided by mortgage rate divided by 12. So we got a monthly payment of 742.5. Here is the monthly payment, and this monthly payment is same for each month for our 360 months period, right? Okay, what other thing we need to do is calculate the interest. So the interest is simply the mortgage rate multiplied by the beginning balance divided by 12. Why we divide by 12? Because this is annual rate, but this mortgage payments are monthly. So this will give us monthly interest payable on this mortgage. So it's 677.08. The remaining payment is for the principal payment, and this will be deducted from beginning balance, and we will get ending balance. This ending balance is our beginning balance for the next month. So you can see here it's equal to ending balance, right? And so on. So what I did is I dragged this formula downwards, and this has given me the answer. So if I want to see the combination of principal and interest in any months, I can go to that month. So for example, here the interest payment is 640.38, principal is 102.18. That's it, right? So the one of the main characteristics of fixed rate level payment mortgage is that they are amortized loans, which means by the end of this loan period, the balance, the closing balance should be or would be zero, right? This is because as we pay off this principal payment, our outstanding balance will become low, and in turn our interest payments will become lower and lower. So you can out of the payment, more cash flow will be contributed toward the payments of the principal. So if you see, the main characteristics of this is that over the time period, the interest payments will be decreasing and principal payment will be increasing. So you can see here, so interest payments are decreasing and principal payments are increasing. And by the end of this mortgage loan, all of the loan will be paid off, right? Okay, so let's go back to the our word file again. Okay, so we have looked at the characteristics of a mortgage and we have looked at its calculations. There are some other characteristics of the mortgage loan which we will discuss very briefly. There is some servicing fee. Servicing of mortgage loan involves collecting monthly payment and forwarding proceeds to the owners of the loan, right? So the one who it's not necessary that who is extending loan to the borrower is the owner of the loan. So there are middlemen of financial institution who service the loan. What they do is they collect monthly payments and forward them to the owners, sending payment notices to the mortgages. They also send these payment notices to the mortgages that you have to pay now, reminding mortgages when payments are overdue, maintaining record of the principal payment, initiating foreclosure proceedings if necessary. So if someone defaults, they initiate foreclosure, and furnishing tax information to borrowers. The servicing fee is the portion of the mortgage rate. If the mortgage rate, say for example, the problem example we discussed, it was 8.125, and the servicing fee is 50 basis points, then the investor receives 7.625, and the interest rate that the investor receives is said to be the net interest or net coupon. The remaining is servicing fee, which we refer as servicing spread. The dollar amount of servicing fee declines over time as mortgages amortize. This is true for not only the mortgage design that we have just described for, but for all the mortgage designs. And it's natural, because if you remember that as we go for as a loan matures or it becomes seasoned, the amount of interest declines. As the amount of interest declines, so is the servicing fee, because it's defined as a percentage. The second characteristics of these mortgage loans we have to discuss is prepayment and cash flow uncertainty, which is very important, and we will be discussing this in detail. Homeowners have the option to pay off all or part of their mortgage balance period to the maturity date. So a payment made in excess of monthly prepayment is monthly mortgage payment is called a prepayment. The prepayment could be pay off the entire outstanding balance or a partial pay down of the mortgage balance, right? So when a prepayment is not the entire outstanding balance, it's called curtailment. Otherwise, it's called the all balloon payment, right? The effect of prepayment is that amount and timing of cash flow from a mortgage loan are not known for with certainty. This risk is referred to as prepayment risk, right? Remember, we have talked a lot about payment risk, and we have defined it already. Most mortgages, okay, most mortgages, so for example, let's take an example. For example, all that lender is owing 100,000 mortgage we just discussed, and mortgage loan is dead. As long as loan is outstanding, the borrower does not default. Interest will be received and principals will be repaid scheduled date month. But let's consider that what the investor not know that the uncertainty is for how long the loan will be outstanding, and therefore the timing of principal payment will be uncertain. So the borrower can pay if he got money from any source, he can pay off the mortgage, right? Okay. Mostly mortgages do not have prepayment penalty, but a prepayment mortgage, there can be a prepayment penalty mortgage that for a certain period of time, if borrower prepay, they will be charged with a penalty. This period is called lockout or penalty period. During the penalty period, the borrower may repay up to a specified amount of the outstanding balance without a penalty. Our specified amount of the penalty is set in terms of number of months of the interest must be paid as a compensation, right? So this is just to summarize what we are going into. So this is the simple basic mortgages. In the next video, we will turn our heads towards the mortgage-backed securities. Thank you.